Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us on another Sunday live stream. Got my beer money going, so grab your favorite beverage, adult or otherwise. Let me know where you're coming at from the Bowtie Nation there in the world, and we're gonna get started because we got a really essential, kind of a stock market basics video for you today. The how to follow the market news, but it's not really how a lot of investors think. I think a lot of investors out there, they follow the news on, whether it's Bloomberg or Fox Business or, even online on Yahoo Finance, and they're very reactionary to it. Okay. So they see that a deal has been announced or something, and they always run out there and they're just reactionary to the news. They jump on, the hot stock that just had some news come out. And the problem is those prices have already changed. Those prices, the market has already baked that news in almost immediately. Okay. You've just got so many people out there following the news, jumping on it. You've got a lot of these high frequency traders that are trading on the news. And, the retail investors sitting at home watching TV or surfing online really don't have the chance if they're that reactionary type of investor when they're following the news. Instead, what you want to do is you have to use that market news, follow the trends, and then think through it. Where is the news heading, and then jump out in front of that next move. And that's what we're really going to do today. We're going to talk about today kind of the current stock market news out there, the investing news out there, where it might be heading, and I'm going to share the top resources that I use, all free resources for the news that you can use to get out in front of the news and really get the best information out there. So again, thank you for being here. I love these Sunday live streams just because it gives me a chance to reach out there and get a little bit closer to all you out there in the Bowtie Nation. A little bit more engagement and interaction than we usually get on those those regular videos. So I want to get started. I do want to invite everyone again to join the Bowtie Daily. That's our daily market update. It goes out every night, 9 p.m. before the market opens the next day. It's going to have all the most important market news, really a lot of the stuff we're talking about, all the trends, the sectors, the top stocks of the day, and then really just an analysis of the day's most important news that you can use. It's totally free. It's just something I've started this year. Already 10,000 people signed up for the newsletter. So I've left a link there, pinned comment there to the link to sign up. I'll also leave it in the comment section below and in the description. So sign up. It's totally free. Just something I like to do for all you out there in the nation. So it's kind of a daily market update in in the news. But I want to get started because this is an extremely important topic. Not just what we'll talk about as far as what's happening in the market right now, but what's how to use that information, because again, you can't just be reactionary to the news. You have to be proactive with it, get out in front of those trends that we talk about, and make that work for you. So with each of these, I'm going to be talking about what's happening in the market right now, the investing news that's out there now, and I'm going to show you how to find that, how to find some of the best information that I use to analyze all that. And then of course, at the end we'll always leave room for a Q&A, because that's really what I do these for, just kind of answer your questions and kind of get that conversation going about what you're looking at in the markets. So we're going to start off with, obviously, probably some of the biggest news right now is just those fourth quarter earnings, right? And with earnings, so those of you, any publicly traded company, they're going to report their earnings 4 times a year, right? For every 3 months, they report the sales and the earnings that they made, the profits that they made over those last 3 months. So it usually lags about a month or two from that quarter, right? So the last quarter of the year is October, November, and December. Companies usually start reporting that earnings picture in late January, early February. We're about halfway through so far for earnings, and they've been remarkably good. Okay, and a lot of times, what's almost even more important, because our market, by the time earnings come out, the market really has a great feel for where those earnings are going to be, and kind of the the profits for a lot of these companies. But what's more important is in the outlook that these companies give, the guidance for the full year or even the next quarter. Okay, so far, in the for the fourth quarter earnings that are out now, a lot of companies are giving their full year 2021 guidance, and that's obviously extremely important for analysts and for investors to see, okay, so where are earnings going to be over the next year, since the market is forward looking. Okay, the market prices, stock prices always bake in pretty much what they expect over the next 6 months to a year as far as the economy, as far as earnings. So this outlook is very important for the market to kind of readjust to where it thinks earnings are going to be over the next year and be able to adjust prices to that. Okay, so what I want to do is start out here is show you probably one of the single best resources for for earnings. Okay, and for a lot of stock market news and stock market analysis. This is probably my favorite resource right here. We'll go to Google. And this is called FactSet Earnings Insight. Okay, you can find this anytime you want. Find this by typing in Google FactSet Earnings Insight right there, and it's almost always going to be the very first link you see. Okay, so you can click on that, and it's going to be a PDF file, right? And we'll just enlarge this a little bit so you can see. And basically what this is, FactSet, company FactSet, a researcher comes out with this, and they update it about every 2 weeks, right? Usually every week during earnings season when those earnings are coming out. And the great thing about this is, I mean, they just really take a deep dive into the S&P 500 company earnings. Okay, so you're going to start off with you get kind of key metrics, earnings scorecard and stuff, and you get a feel for how companies are doing as far as those earnings reports. So like it says here, we're about 60% of the companies in the S&P 500 reporting actual results already so far for the fourth quarter. And 81% of those have reported positive EPS surprises, earnings per share, right? 79% have beaten revenue expectations. So, right. So when you hear that a company surprises the market in its earnings or in its sales, that means it beat those expectations that the Wall Street analysts were expecting it to report. And don't think 81% is some ungodly huge number. It is higher than average, and we'll look at that. But it's usually right around 70%, 70 or 75% even, that they beat these expectations. And it's kind of a game that the companies play with Wall Street and with investors. Obviously, no company management wants to come out and say, you know what, you were expecting us to report $5 in per share earnings and $2.2 billion in sales. We didn't quite make it. We weren't quite there. We only maybe only reported $1.25 per share earnings. It makes management look really bad. So what management does is they kind of play this game with Wall Street analysts. Frankly, are kind of complicit in it as well. Throughout the quarter, throughout the year, they'll talk down their earnings a little bit. They'll give warnings or or in that outlook that they say, they'll they won't give an extremely positive outlook. Okay, they'll say all these things that could come in and hit earnings, right? So they'll kind of keep expectations low. So when they do announce those earnings and come out with those results, they almost always beat, right? 70% of the stocks usually beat earnings, and we'll look at the actual number here. They disclose that. But even that said, 81% of companies beating earnings, as well as 79% beating revenue, that is on the upside. So we are actually looking at a very good earnings picture for the fourth quarter and going forward. And what I like, this FactSet earnings insight just has an amazing amount of charts and tables and information that you can use. So I'm not going to read through the whole report. You can look for the report and read that for yourself. It's just kind of one of the best resources that we'll look at, and all of you out there in the Bowtie Nation, you're going to recognize a lot of these charts that we'll look at real briefly because I use them on the channel so much. As of today, S&P is reporting growth in earnings of 1.7% for the fourth quarter. Now, that's really important because we actually saw the 2 quarters before that was a decline in earnings. Obviously, pandemic related. S&P 500 companies were reporting earnings losses over the year-over-year basis. So this earnings growth in the fourth quarter, that marks a turnaround. That marks a turnaround, a break in the recession. So the economy and these companies actually started growing again in the fourth quarter. Very important, not just for that earnings growth, but just for investor sentiment. Okay, and so we see 5-year average of these companies, 81%, which is above. Okay, so here you see it says so of these companies, 81% reported actual earnings per share above estimates, like we talked about, which is above the 5-year average of 74%. Okay, so again, the vast majority, three-quarters of companies almost always beat those estimates, beat those expectations. But this last quarter, it was 81%. So definitely a positive for sentiment. Companies are making more money than analysts thought they would. And it just goes on. It breaks these down into every sector. Okay, right? And we'll look at sectors. We'll talk about sectors in a minute here. But just, all 11 sectors of the economy and the stocks in each. It tells you, which sectors are doing the best as far as our earnings, which ones are lagging, and the outlook. So let's just look at, some of these charts. It'll show you charts for earnings growth in there. It'll show you, it usually has one or two topics. So how much is consumer spending still being impacted by the pandemic, by COVID-19? Great research here. If you want to know, okay, so is the coronavirus still holding consumer spending down? Might we get that pandemic boost, after the pandemic, the pent up demand that everybody is talking about and that supposedly is supporting stocks right now? So retail sales, and I actually haven't seen this one. I just opened this today and I haven't seen this. Retail sales fourth quarter year-over-year growth by category. So it looks like food services is still down 17%. Food services spending and drinking places, so bars, establishments like that, still down 17% year-over-year in the fourth quarter. We've got gas stations, which so people are driving less, obviously from that work from home environment, that kind of thing. But some of these, look at some of these non-store retailers, sporting goods are up 16% year over year. So actually they're getting and I imagine a lot of this is that hobby, book, and music stores that, maybe people are buying things for, for the lockdown. So they're stuck inside still. They're reading more. They're doing more hobbies. But just some great information as far as, in the retail space, who's benefiting and who's losing out in that pandemic. So you can read through that, and I want to just look at a couple other charts here that they usually have, just to show you kind of what you can find in this. You've always got net profits, current year earnings and sales expectations. You've always got next year earnings and sales expectations. So FactSet, what it does, it surveys all the analysts. It surveys a lot of the analysts that are covering the S&P 500 companies, and to see, what are they expecting for sales this year, next year. What are they seeing as far as earnings, that kind of thing? Which companies are reporting, earnings growth? And a lot of really great stuff here. Let's get to one that I like a lot, and I can show you. Okay, so here it shows you market earnings expected by the analysts. So you can see that current year 2020, which is last year, but currently reporting. Analysts expect Wall Street or the S&P 500 companies to report about $140 per share earnings for the whole S&P 500. Okay, then they're expecting a rebound up to $173 per share for the S&P 500 at large. And that's important because obviously, look, 2019 they reported $163. So if they meet analysts' expectations, and again, they usually beat expectations, so I would expect this to be, maybe 174, 175. If they do this, then it marks a huge turning point for the market. They've completely, clawed back all the earnings that they lost last year, and are actually going to be at a higher point according to analyst expectations. So you got that. Another one that I like to show a lot. All you in the Bowtie Nation will recognize this chart, and it's not showing up very well in the. I realize it's not showing up in the graph here. Let me just move this over here. There we go. Okay, so you see this chart, and it shows you the sector level forward 12-month PE ratios. Okay, so these are the PE ratios, the current price of the stocks in each sector divided by the what analysts expect those stocks in that sector to report in earnings over the next year, right? So it's kind of a forward, it's that price to earnings ratio, but on a forward basis. And you can see, these dark blue lines are the current, the 10-year, the green lines are the 10-year average. And you can really see, how expensive some of these sectors are. So it's just a great way to see, how expensive stocks are in each sector. Maybe you're looking for some of those value sectors, that kind of thing. Here you see the 12-month PE ratio over the last 10 years. So, you can see the PE ratio clear up here, or that's the price to earnings. That's the EPS change. Here's the PE ratio, okay? And let's see if we can, there we go. Okay, so you can see the PE ratio all the way up to about 21.5, right here. That's the forward PE ratio. Highest it's been in more than a decade. Actually, highest it's been since 2000. You can see the blue line here is the 10-year average. So you get a feel for how expensive the market is and where it's going or where it might go from there. So that's the FactSet Earnings Insight. Again, really easy to find, free resource. They update it every week, and just an excellent resource to kind of look at the current earnings picture and where it's going. Now, when you are thinking about the news, the investing news, and where that's taking the market is over the short term. So we're talking anywhere up to a year, right? For stock market prices, it's completely sentiment driven. Okay, these earnings play a part in sentiment. Obviously, if a lot of companies come out, like we saw, 81% coming out beating the market expectations for their earnings, beating it on earnings, beating it on sales, then that's going to add to positive investor sentiment. If they all come out and they're all missing expectations, they're all providing negative outlook, then that's going to hurt the market sentiment. But really what you want to do is use that as a sentiment driver, not necessarily as a valuation driver, okay? Because that 1 year period, anything from now out to a year, it's all just how do investors feel about the market? How do where are the money flows coming from? Now, beyond a year, okay, so what you want to do if you're using this for valuation, beyond a year, it's those earnings, it's the economic growth, and where is the economy going? Okay, that's the ultimate, the ultimate valuation for stocks is in those earnings, because stocks are a future call on those earnings. Okay, it's an ownership of the future earnings reported by those companies. So, sentiment is king over that 1 year period, but over the long term, to see higher stock prices, you got to see higher earnings. Okay, so this is a great resource also, not just for that near-term trading kind of idea, but also to see, okay, which companies, which sectors are growing their earnings over the long term and are really going to be able to benefit the stocks in that sector. Next, talk about kind of the stimulus situation, right? Because obviously over the last year, stimulus, whether it's monetary through the Federal Reserve or fiscal through the government, has been a huge part of the market. Okay, with this $1.9 trillion stimulus package that's being proposed by the administration and actually starting to negotiate on that this week. That would bring the fiscal stimulus, so the government stimulus, up to $5.3 trillion. Okay, and just to put that into perspective, the entire economy of the United States is only like $22 trillion. Okay, so just government stimulus alone, just the government pushing this money out into the economy, that is upwards of 25% of the entire economy just being pushed out there, into people's pockets. So obviously that's important, because if you can't push money out in the economy without seeing higher asset prices. Okay, people aren't really spending a lot of this money; they're just pushing it into stocks, things like that, and pushing stocks higher. Okay, I see somebody in the comments is just looks like it's just trying to push stock picks. So I'm gonna go ahead and hide this user on there. Folks, you know what? Don't use the comments to spam your stock picks. Okay, that's not what we're here for. You go to Reddit or wherever you want to spam your own stock picks, and we're here to be better investors and to learn about this stuff. So yeah, the stimulus, they're going to be negotiating in Washington this this coming week. We're hoping to get at least 1.2, 1.3 trillion of that 1.9 trillion. President Biden actually came out just recently and said that the increasing the minimum wage wasn't going to be in that package. He's kind of negotiating with the GOP on that side, but he's putting a marker, a marker out there that the checks are going to be $1,400. Okay, the GOP came to him, about 10 GOP senators came to him about a week ago, said, look, we want $1,000 checks instead of the $1,400, and we want it to go out to fewer people. Okay, we want those higher income limits. Biden originally said that, so he came back and said, okay, you know what, I'm willing to raise the income limits on these, on these checks so fewer people get them, but I want the $1,400 to go out. And that's really what he's kind of sticking to. So the $1,400 in checks is probably almost a definite at this point. It's probably going to go out to fewer people, so it's going to cost less in that stimulus package. They're going to save a little bit of money on that. But so we got that. We've probably got some state and local aid. We've got some obviously pandemic, COVID and vaccine spending going in there. So the market is expecting probably, I'd say, at least $1 trillion, maybe 1.2, 1.3. I'd say anything less than 1.3 trillion in that stimulus package that finally gets approved, it's going to be a disappointment for the market. Okay, so I would expect them to try to get at least as close to 1.5 or higher than that. Or stocks are going to fall in. If that comes out to 1.3 or less. As far as finding the news on this kind of thing, I'll go over some other news resources here towards the end. But I want to jump over to interest rates and inflation, because I know this kind of economic talk isn't as sexy as talking about maybe earnings or Bitcoin or wherever the current topic of the day is. But I think this year, 2021, interest rates and inflation are going to be one of the major drivers of the stock market. This stock market news around rates and inflation are really going to drive the market. And why is because, rates are so low. Rates are one of the things that, the Fed has lowered short-term rates to pretty much zero and has promised that they're going to stay there for at least another year or two. And it's really supporting the market. Obviously, not hedge funds, but pensions, institutional investors, and older investors, they're not getting anything out of their bonds, right? You can't invest in bonds and earn a return right now because of those low rates. So they're pushing all that money, all that investment into stocks. Of course, that pushes asset prices up, pushes stocks up. Well, what happens when those rates go back up? When rates go back up, then those stock returns, the bond returns look more attractive. The stock returns don't look as attractive. We covered the earnings yield a couple of weeks ago in our live stream. Very important to look at that. Basically, the earnings yield is just, you can look at the return on maybe the 10-year Treasury, right? And I'll show you where to define that pretty soon here. You look at the return on the 10-year Treasury, and let's look at that now. So you can go to Yahoo Finance, and right across the top bar here is going to be all these. And if you scroll over one, you'll find the 10-year bond, right? And the 10-year bond is just the U.S. Treasury bond. That's pretty much the benchmark that is used for interest rates on the long end of the curve. It's up at 1.17 right now. They're at the peak, at the height of the pandemic. That was down as far as 0.53%, 0.54% on the 10-year Treasury. People could borrow money for 10 years from the Treasury at almost 0.5%, right? But it has come up here to 1.17. And what you'll see, you can take a longer picture. I mean, just in the last 5 years, just since 2018, it was up above 3%. So what you want to do with that, part of that is that your earnings yield that I was talking about. So if you're looking at people can make risk-free, because the U.S. Treasury, the U.S. government is always going to repay its debt. It'll just print more money if it can. You can make 1.17% on a risk-free rate. Well, what are you making on stocks right now? If you're talking about stocks in the technology sector, if you take the inverse of the price to earnings ratio, right? So the PE ratio for tech stocks is right around 35, 40 times right now. So if you take 1 divided by that, and this is just a real quick, easy way to get the earnings yield. Usually you'd have to take the earnings divided by the price, right? Because it's just the opposite of that price to earnings ratio. Or you can just take the PE 1 divided by the PE. So if tech stocks are trading at 40 times price to earnings, you're getting about a 2.5% earnings yield, right? So what's that saying is, for the earnings in the tech sector, investors are getting about a 2.5% return on the price, right? Well, how does that compare against treasuries? And you can see, as treasury rates come up, if rates came up to 2%, would it really be worth the risk and the trouble investing in tech stocks? And this is what you're going to hear in the market news and on a lot of the investing shows. As the interest rates come up, people are going to say, you know what? If the risk-free rate is going to pay me 2%, do I really need all that risk in tech stocks for an extra 0.5% earnings yield? Okay, so that's really one of the big the big hurdles for the market this year is the interest rates and inflation, because inflation drives up the interest rates. Okay, and again, like we've been talking about, you can't just push $5 trillion into the economy and then another maybe $4 trillion from the Federal Reserve, which is with its low rates and bond buying programs. You can't push that into the economy without there being inflation. Okay. As people get out, as people get out of the house, they start spending some of this money that they've saved. You're going to see inflation come up. Okay, so that's going to hurt the bottom line for a lot of companies. So earnings are going to be, might not go up as much as expected. Earnings are going to be, held back a little bit because those profit margins. But also it's going to push interest rates up. Okay, so that's going to be just another factor in pushing that interest rate up and making maybe stocks look a little less attractive next to bonds. Okay, another thing I want to talk about here is sectors, right? And this is something that, everyone that's looking at everyone that's signed up for the Bowtie Daily, that daily market newsletter, you see this every single day. You see these sectors and how to play them. And why this is important is, and we'll go here to where I get that information from every single day. You go to sectorspider.com. Okay, so this is that's sectorspdr.com. Okay, that's sectorspider.com. And you can just Google Sector Spider, sector tracker if you want, and it'll take you right here. And then what's really cool about this is going to show you the all 11 sectors of the economy, plus the S&P 500 index, so the broader market index. And you can do this for each day. It shows you, how each sector did it in the day, over the last week. It's got year to date. It's got 1 year. So you can see how each of these sectors is doing over the last year. And it really gives you an idea of, okay, which sectors are booming, which ones are lagging, might be value opportunities, which ones, and then, you kind of got to put your own narratives behind that. Okay, so why are utilities and real estate doing so badly over the last year? Well, one is that interest rate picture. Okay. As interest rates go up, these yield sensitive, these rate sensitive sectors like utilities, like real estate become less attractive. Those are the first ones to get hit from these, okay? Because, utilities don't grow very much. The stock prices of these don't boom higher like tech stocks. So basically investors are in these utility stocks just for the dividend, right? Well, if they can get a higher yield off of bonds, that's less risky, then why are they going to put their money in these utility stocks for dividends that aren't as comparable anymore? Same thing with real estate. Real estate, most of the return in real estate is from those dividends. So if someone can make more return in bonds, as those interest rates go higher, then that's going to draw a lot of money out of those sectors. Obviously, for energy, it has been over the last year. Oil prices went negative over in April, so that hurt the energy sector. It's actually one of the top performing sectors over the last 3 months. Actually, it is the top returning sector over the last 3 months. And then financials here is really that interest rate picture as well. Those of you in the nation that have been watching the videos, have been following the 2021 portfolio, those are really my favorite two sectors right now, is this energy, financials, and then healthcare as well. Just because, I do see commodity prices coming up with that inflation, with the weaker dollar. Financials are getting helped by those interest rate spreads. Okay, so the Fed is keeping interest rates on the short end down. No interest rate increases for at least a year. It's going to be pretty much zero interest rates on the 3-month Treasury bonds, right? But longer term rates are going up because longer term rates are influenced by inflation. They're influenced by economic growth, things like that. Okay. So as the as the economy recovers, as inflation goes up, then it's bringing up those longer term rates, the 10-year, the 15-year, and the 30-year treasuries. So what happens there is, if you've got short term rates down here, those are the rates that banks are paying their customers, right? Their savings, and they're not paying anything right now. Anyone with a savings account knows you're not making any money on that anymore right now. But the longer term rates are keep going up, and that difference right there, the longer term rates is what banks lend out in their mortgages. So they're making a lot more money as those interest rates keep going up. So that's why I think financials are going to do really well this year as we see interest rates go up. And one of the other things that I like about investing in the banks, the financials right now, is if interest rates do become a hurdle on the rest of the stocks, on tech stocks, on some of these other sectors, and kind of hold the market back, you're still going to make money in the financials, right? Because those bank stocks are going to do well. So you're actually going to be benefiting as the rest of the market loses out on those higher rates. So that's that. Energy has been doing really well, but this is just a great resource. This sector tracker, sectorspider.com. It's their sector tracker where you can see what all the sectors did each day. Again, in our daily market newsletter, the Daily Bowtie, we always have the top 2 and the bottom 2 performing sectors of that day, and I give you the sector trends, what I'm watching in those sectors. So make sure you sign up for that. It's totally free. So you're going to want to watch for that, and again, it's not maybe looking at the sectors isn't as sexy as thinking about, okay, which individual stocks are booming. It's not as fun as talking about GameStop and its 400% return over the prior week, although it's lost about 80% of that. It's not as fun as talking about Tesla or some of those others. But looking at the sectors is really going to give you an idea and help you narrow down your investment list to the stocks that are going to work for you. Okay, so I can look in here and say, okay, energy is doing really well right now. It's underperformed over the last year, so maybe I want to look in energy for some of the best stocks. That narrows it down to from about 5,000 companies traded on the U.S. exchanges to maybe a couple hundred or a few hundred energy companies that I want to narrow down and focus in on to find those really hot performing stocks over the next year. So don't avoid those sector ideas and the shifts in the market. And then the last one, and then we'll talk about how to use this news. Some other resources that I like is just following the trends. Okay, and right now the big trend is in that retail investing space. How are investors, Main Street investors, using this social media to really beat a lot of these hedge funds and the institutional investors out at their own game. So kind of looking at that, how long can that go on? What's the next target? Things like that. So now I want to talk about kind of how to use this news, some other resources that I use. So one of the things you can do is kind of look at, okay, what's supporting the market right now? What's driving stocks up to an all-time high, right? The crazy thing is we went from the worst week since October. Okay, week before last, the S&P 500 had its worst week since October, fell about 3.3%. To the best week since November. Last week, stocks rose about 4.6%, right? It was the best return since October for a 1 week period. And so it's kind of weird when you go from the worst to the best all in 1 week. And it's because you look at this news and you look at what's supporting the markets right now, those earnings, the coronavirus vaccinations that are going out, and the idea that we're going to get back to some kind of normal. But then you have to think, okay, what comes after that? Okay, because again, you can't just take this news and be reactionary. You can't just jump into stocks because the S&P 500 and the NASDAQ hit all-time highs over this past week. You got to think, okay, so what's supporting stocks right now? It's those earnings. 81% of the companies are coming out beating expectations. You've got stimulus, which is about to move into the negotiation phase this week. People are counting on that to push stocks up. Where does it go from here? What's that next leg? What's the next news that comes out from this? And how can I get in front of that? So in that theme of trying to play a contrarian sometimes, you think, okay, well, earnings are almost done. We're 60% of the way through. The market is pretty much built in that idea that everybody is beating earnings expectations. So what happens next, when earnings go out? And when we're into the first quarter. It might the market be be disappointed a little bit if so some of these negative earnings announcements come out once we have the stimulus out. Yeah, it could be a big boost to asset prices as people deposit those checks into their brokerage account. But what then? It's going to be very hard negotiation to push this stimulus deal through. In fact, the Democrats in Congress are trying to do it through budget reconciliation, which I'm not going to go into the politics there, but it just means that they can get that money through the Senate with just a majority vote, right? And they've got the majority right now. So they can pretty much push that through if they want. They don't really have to negotiate a whole lot, but they can only use that a limited number of times, right? So what happens is once they pass this stimulus, it becomes very much harder for the rest of the year to push anything else through the Senate without that 2/3 vote majority. So what happens now is that we get all this positive news now. And it's supporting the markets, driving the market up to all-time highs. But is there disappointment waiting for us? We actually had a big disappointment in Friday's jobs report. Only reported 49,000 new jobs over the last month in the United States, whereas it was expected to be right around 100,000 made. Even worse was the November and December numbers were downgraded. They actually said that they lost another 160,000 jobs more than we thought they did when they were originally reported. So, we've still got massive unemployment. Everybody's, almost 800,000 people are filing new unemployment claims every single week. And how does this catch up to the market? The market's forward looking, so it should be looking out, 6 months to a year to see where the economy is and where earnings are then. How does it move that in there? What about these interest rates and the inflation? We've already talked about that a little bit as far as, okay, so as we see interest rates go up, we're going to see it start spooking the market, especially I think, once interest rates hit 1.25% on that 10-year Treasury, you're going to start to see more people talking about this and how, maybe it's just not worth it to go after stocks when their earnings yield is only 2%, 2.5% against a Treasury, a risk-free rate of 1.25%. So you're going to start seeing more people talk about this, and I think you're going to start seeing it hold back the market a little bit. I just want to cover some other news sources that you can use that you can look to before we get into the question and answer. I see a lot of questions already on here that I want to cover. One, obviously, your Bowtie Daily. I pinned to the comment there. Sign up for that, or look in the description below the video to sign up for that. It's totally free, and I'm covering all this stock market news, all the the sector trends, everything every single day before the market opens, 9 p.m. the night before, to give you time to plan your next day. Some of these other sources that I use that I wanted to point it out. So we've got the Wall Street Journal, obviously, is a solid resource. It's actually a little bit cheaper than some of the other resources. I've always been kind of more of a fan of Bloomberg myself, but it's I think they want like $30 a month for the digital subscription on there. Wall Street Journal I can get for $10 a month. So I use that a lot to look at my news. And what a really good source for not just investing news really in stock market is kind of a broader personal finance source is Morningstar. And you can get a lot with a free account. I've actually got the premium account, which is a little expensive at about $420 a year, I think. So it comes down to about $30 a month on there. But you get a lot of great stock screener tools and stuff like that with the premium. But try it out. Try the free version out, because you get a lot of stuff with that. And it's a really good resource, not just for stock picking, but also for for that personal finance and retirement advice. A few other resources that I use that I'd point out: Reuters. So Reuters. Reuters.com is a great news source, very unbiased. So they're not putting out news for the left or for the right. It's really right in the middle there, putting out unbiased news. Great resource for kind of the overall news, not necessarily just the market news, but just overall. So that's really what you want to do when you're looking at the news, when you're thinking through some of the investing news that's coming out. You want to be proactive about it, not reactionary. Think, where is this heading, and what are going to be the next challenges, the next hurdles for the economy. Now I want to turn this over to the to the questions here, and I'm going to